Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is the penultimate webinar of the year. In fact, it's a weekly webinar, as many of you will know, where we focus on the key events and themes driving markets at the moment. We look at both technical ideas, technical analysis, as well as many of the fundamental themes and drivers of the market. Whilst I'll just let you have a look at the disclaimer, I'll just run through our main objectives and what we'll be looking at this week. Firstly, as many of you will know, we'll just take a brief look at markets in general as they set up for this most pivotal week, potentially of the year, or especially pointing us to key themes for the start of next year, especially. Of course, we have some major central bank meetings, as well as a calendar full of top tier data as well: US CPI, UK CPI, US retail sales, and then just this whole bunch of probably 10, I think, regional and major central banks giving us their decisions and potentially their guidance, as I say, for next year. So a lot to get through, actually, and a lot to look forward to this week, especially. We'll start generally, as I say, with how markets are setting up at the moment. We'll then look at some of the ideas for a couple of paths for markets, if you like, as well as then 3 points for equities as well, equity markets at the moment. We'll then look at some of the technicals of the major stock indices before then jumping straight into the key events of this week. So the Fed, US CPI data, and then the ECB and the Bank of England on Thursday. We'll run through all the fundamentals behind that, what's priced in, what's expected, and then also look at some of the technicals, so sterling, dollar, euro dollar, the DXY chart, of course, and a few other majors if we can. Okay. We'll start off first, as I say, with just a brief look at what's happening at the moment and a couple of ideas around markets to share with you. Of course, we get, as I said, virtually every major central bank, apart from the Bank of Japan, will be appearing with their latest interest rate decision and guidance. As I said, around 10 top tier or tier 1 and regional central banks weighing in. The week really will play a huge role in determining if central banks, and especially the Fed, need to keep policy tighter for longer or can start to relax a touch over rampant price pressures, of course, that we've seen this year. And then potentially we can consider rate cuts into the second half of next year. Among those different paths from where we are currently, then, the one the market is least prepared for is the one that shows resilient US economic growth and then higher than expected inflation in the coming months. But even if data does continue to prove the market's strong conviction that inflation is headed lower and growth will soften, the question then is, will markets price some version of a soft landing? Or will the fears around the kind of standard recession cycle begin to weigh on risk sentiment slightly more as asset prices drop on fears, of course, of rising unemployment, which we haven't seen so far, of course, and then falling profits? At the moment, as we've been kind of saying in our daily commentaries, if you pick up on any of those, financial conditions have been easing sharply and credit markets look quite complacent. So there is not a lot of fear really priced in at the moment. Okay, so just that's a sort of general theme that we're kind of thinking about to start the week at least. Markets are relatively quiet. We've obviously had quite many months, a wild year, if you like, of volatility, and especially the sort of large, big bank players, macro players, are probably unwilling to place sort of major large bets on the direction for markets until we've seen some of this data, the decisions, and probably then they'll be waiting until the new year. So something to bear in mind as liquidity may be thinner, we may get more volatile moves, in fact, more whippy, sort of choppy price action, if you like, as we go into this festive period. And as we obviously have then these major central bank meetings to come. Data release last week was kind of mixed, really. We had that producer price index, PPI, data on Friday that beat consensus expectations. The ISM services data, that was also solid, expanding for the 30th month in a row in November. But then we had other price data, actually, quite obscure unit labor costs, which was sort of looked at in more detail than normal midweek. That was revised lower, revised down, and kind of seen as evidence that second round inflation effects aren't in play. And that kind of then suggested that the Fed won't be as aggressive against inflation as it says it will be. Interestingly, Wednesday's rally actually that we saw in the bond market saw the US 10-year yield, which we've been looking at over the last few weeks, that fell below 3.5% support. And that was a previous cycle peak back in June. And we also got actually the Bank of Canada, they hinted on Wednesday as well last week at a potential pause in its tightening cycle after a 50 basis point rate hike to 4.25%. If you remember, we did, I think, talk about that and the potential for a 50 basis point rate hike, but then sort of less hawkish language as opposed to a 25 basis point hike. And then more hawkish language. So yes, interestingly, the US 10-year yield that tested the 50% retracement on the August-October move higher. That was at 3.42%. And that coincided actually with an incoming downward trend line. In fact, before we just look at the that graphic I've got at the moment, I'll just take you to the 10-year. I don't want to get, as I always say, too technical on this, but always an important indicator for us, for markets, the 10-year US Treasury yield. You can see this chart. We just take off the 50-day moving average. So yeah, just referring to that move last week, as we said, dipped sorry about that, but dipped down to 3.42%. So that's the 50% marker of this move up that we've seen from August up to the highs above 4.33%. This is the US 10-year yield. So we dipped down to 3.42% or so, below the 3.5% mark, which is widely watched, of course, and then we'd sort of back up there. This is the 100-day moving average at 3.51%, and we're now just above 3.5%. So interesting move for the 10-year US Treasury yield. And that sort of takes us on quite nicely to the what we have been looking at recently, which is this yield curve inversion. So just as we've said, the gap between the widely watched 2-year yields, which follows the Fed funds rates, so interest rates in the US, and of course a 10-year sort of barometer for borrowing, if you like, in the US, a 10-year US Treasury yield. So the gap between those, that's recently touched, I think, 0.85%, so 85 basis points. So the widest it's been for many years. And you can see on the chart then that this is the gap showing that, and these grey periods are really where recessions have been seen. So you can see where we dip below, where we go into negative territory, essentially, then a few months later, we get a recession. And this is obviously what has been grabbing the headlines recently. The market then has been increasingly adding to rate cut expectations in the second half of next year, and that's further inverting the money market curve, essentially. And it goes directly against that messaging of the Fed, which is sought to convey the idea that key interest rates will stay higher for some time. And again, we've been writing about that in our commentaries, daily commentaries, that is, in this sort of collision course that potentially the markets are on with the Fed, and that we'll see, and we'll go into more depth very soon. Regarding US equities, then, they notched their biggest weekly drop, actually in more than a month, last week, as investors kind of took the hotter than expected Friday data really as a sign that the Fed would keep interest rates higher for longer, as we've said. The S&P 500, that fell 0.7% on Friday, taking the weekly drop to 3.4%. That's its biggest decline. Since late September. Of course, it has bounced about 10% from the October lows, but remains down around 17% or so on the year. Tech-heavy NASDAQ, that closed lower by 0.64%. Finished the week down around 4% or so. That's the steepest slide since early November. We've got the S&P chart here, but just as I said, three things for us to note about equities, really. One, firstly, equity positioning remained lower than it had been for about 86% of the time since January 2010, though it has crept slightly higher in recent weeks. That's according to a report by Deutsche Bank, published at the start of this month. And then secondly, we note that according to a survey by the Bank of America, they survey fund managers, they note the cash levels among investment managers, fund managers, stood near multi-decade highs last month. So that's cash levels, very high levels still. So again, interesting that they've stood on the sidelines even with this sort of 10% bounce in the S&P and bigger bounces elsewhere. Finally, of course, we need to talk about probably seasonal effects. The S&P down 3.6% around that marker this month. But according to Dow Jones data, that index has ended higher in the final month of the year more often than any other month. And has risen actually on average around 1.5% in December since 1950. So I guess the question there is just, will seasonals take us into year end, kind of absent any surprises that we get from the US CPI data or, of course, the Fed, whether then we get this so-called Santa rally. There is a piece hopefully on the website about that in more detail. Really, the Santa rally is kind of specifically really the last week of December, the first 2 trading days of the new year. And there's a few stats around that. 7-day period really averages over 1%, I think, which is kind of the third best 7-day period of the year. Hence the name, the Santa rally. Kind of not really associated with a full-on December rally, if you like, through the whole of the month, but those 7 days between Christmas and New Year, the 25th of December and New Year, and then the first 2 trading days of the new year, 2023. So yes, a couple of things to note for equities then. Those 3 points really: cash levels, equity positioning, and then obviously seasonals as well. If we look at the technicals, just to note, of course, the S&P failed to break above that trend line resistance that we've been highlighting around 4,100 or so earlier this month. Then we broke below trendline support that you can see there around 3,992. That was last week, and we're kind of oscillating around that, just above the 100-day moving average at 39.30. You can see there as well. So that's acting as support. We've put in a few fib levels here, but certainly sort of 4,000 level, and then just above there, the 200-day moving average at 4,037. That will offer, it looks like, strong resistance to any move higher. if there is, of course, this Fed pivot. But then, yeah, the 100-day moving average of 39.30 looks sort of decent near-term level of support before then we go to the halfway point of the August downtrend at just above 3900, 3908. That's the S&P. The NASDAQ upside capped by the 100-day moving average at 11,955 there. And then support probably sort of minor fib level around 11,214 or so. But we're tracking sideways, really waiting for potential catalysts, of course, from the Fed's guidance potentially, and also that US CPI data tomorrow, which we'll go into shortly. Just looking at the Dow as well, technicals, again, that resistance level at 34,281. We think the August high cap levels there before at the end of last month. And if we lose probably this near-term support, 33,540, sorry, 33,239, then potentially then we head down towards the 200-day moving average at 32,459. So a big gap there with that resistance above. Did like to point out the FTSE, if any of you guys trade that. Interesting, sort of capped the upside 7,600 or so. We sort of struggled at that level a few times now. We've got 7,689 as a strong, even stronger level of resistance. You can see there, but sort of 7,600 up above that is quite tricky for the FTSE 100. And then potentially we roll over back to, say, near-term support. Again, the 200-day moving average at 7,321. That's on the FTSE. Just briefly on the DAX, tracking sideways, really sort of struggled just around 14,500 or so. Didn't quite get back up to the June high at 14,709 there. So just tracking sideways, really waiting for catalysts into the new year. And we kind of course, know what they will be. Okay, the main event, obviously, for us this week will be the Fed and its interest rate decision on Wednesday. They're widely expected to conclude its meeting with an announcement that it will raise rates by 0.5 percentage point, so 50 basis points, and that's slowing its pace after 4 straight 75 percentage point increases. Fed Chair Jay Powell said in a speech only last week that the time to slow its pace of increases may have come as soon as December. And he acknowledged that the Fed was concerned about the prospects of over-tightening policy. For us, he also emphasized that the length of time that the monetary policy will be kept at restrictive territory is far more important now than the near-term incremental pace of hikes. But this slowdown potential has come as US data have begun to show evidence of cooling inflation. In October, consumer prices rose, but at their highest pace, highest rate since January. So that is all to bear in mind. Of course, we'll run through some of the US CPI figures just after this sort of preview of the Fed. The main focus really for markets will be as the 50 basis point hike is pretty much priced in. So the focus will be on the Fed's dot plot. That many of you know is obviously a survey of Fed officials on where they believe interest rates, inflation, unemployment, and GDP, gross domestic product, will be in the years to come. So a graphical representation, if you like, of those 4 key areas for markets, and especially, of course, interest rates. Rate estimates in the survey are expected to have increased meaningfully from September's 4.6% average, and show really a Fed is prepared to keep policy tighter for longer. Those are the expectations really. And of futures markets, they think interest rates will show a peak in May at about 5% or so. And that has pushed higher over the last few weeks with some of those more hawkish economic prints like the recent non-farm payroll data and the ISM as well. But then after that peak in May, around the 5% mark, then money markets, futures markets do show that the Fed then will cut rates by the end of the year by at least half a percentage point, 50 basis points. So that's what markets are thinking at the moment. Interestingly, Fed officials have indicated that some do not expect the bank to cut interest rates until at least 2024. And a dot plot basically showing tighter policy through the end of 2023 that could really force investors who are betting really at present on that looser monetary policy to have to adjust their positions, and that would certainly hurt stocks, growth stocks especially, and then also the dollar. Chair Powell then will be quizzed probably in the press conference on how long the Fed intends to hold rates at terminal. And then while he probably won't get drawn into offering any precise guidance, he has said himself actually quite recently that rates will have to be held at terminal for some time. And that's a line being echoed by many other Fed officials too. And just for some context on that, for how long for some time potentially is, historically, the Fed has typically stayed at the terminal rate for between 3 to 15 months, an average actually around 6.5 months or so. So different again to what the market is pricing in currently with these cuts potentially coming sooner or so. Well, yeah, because the peak would come in May. 6.5 months beyond that is probably November, December, where we see any change to the terminal rate if you're going off the average, but markets pricing in cuts slightly before then. Also, it will be interesting to see if Powell really backs up the Fed's recent rise in confidence in bringing inflation down. And also then his guarded optimism that we kind of saw last week in his speech on the prospects for a soft landing of the US economy. So you can see the terminal rate here on this graphic really sort of peaking around that 5% marker and then sort of rolling over slightly. I think we'll just look at the DXY chart now, just as a gauge to where we are currently for the dollar. We are up still over 9% or so, just below 10%, 9.5% or so this year. But we are down more than 6% in the final quarter of the year. So you can see support around the August lows around 104.63. We're just above that, but we are below the 200-day moving average at 105.77. This is on the DXY chart, on the daily DXY chart. Remember, that's the dollar against a basket of 6 major other currencies, with the euro being the by far the biggest weighting in this index, around 57% or so. So upside cap by that 200-day moving average at 105.77. We've also got a high from June there about 105.78 as well. So kind of pointing lower. The near-term low 104.11. This is on the DXY. Interestingly, and we pointed out actually last week, I think a week before, sort of positioning which had been driving the dollar obviously to those sort of long-term multi-year highs, positioning now where the street fund managers were it was the easiest trade in the book in many ways. The most popular trade for sure was long dollars. That positioning is now far more balanced. And yes, we've seen big bounces in some of the other major currencies against the dollar since sort of October, November, the biggest pullback actually has been seen for the dollar versus sterling. After actually, so the Kiwi the biggest, then sterling. And that's the biggest sort of bounce back actually since the November 10 CPI release. Of course, before we get the Fed's decision and guidance and press conference, we get US CPI data, which is released tomorrow. And if we just go to a graphic, we can see where we are on the chart. Really, consensus for US CPIs. Tomorrow's US CPI is for another slowdown in the headline to 0.3% month on month, with the core at 0.3% as well. Although some have it actually ticking it up, the core to 0.4%. Annual figures for both, so both the headline and the core, are forecast to ease. Headline falling to 7.3% from 7.7% previously. That's down from that 9.1% figure in June, essentially chiefly down to falling energy prices. And again, attention will be on some of the stickier parts to the CPI data, so housing and rent, which are laggards, and they account for over 30% of the CPI basket. In October, core CPI fell sharply after hefty readings in both August and September, and kind of along with some of the other inflation metrics, of course, have resulted in this sort of reassessment of inflation expectations. Many economists now really forcefully making the argument that inflation pressures have turned a corner. So just going back to the Fed, then that 50 basis point hike is baked in. So this data, really, the CPI data, could kind of shape expectations of where then the terminal rate, the peak rate, if you like, will eventually end up. So you can see, yeah, the chart there, the monthly figures on the CPI there, and the changes from potentially this peak, although core is sort of staying slightly more elevated than that headline inflation due to some of those stickier elements. Just point out some of the stock market sort of volatility over this number. The CPI report has been a catalyst for quite outsized swings in markets this year. And you can see on this chart, really, the S&P 500, that's moved on average around 3% in either direction over the past 6 CPI releases. That compares with an average daily move, this is according to Reuters, of about 1.2% over the same period. And you can see those orange markers there where you picked up the volatility is really being quite sharp on the days of the US CPI release. So that includes the September release, which sparked a 4.3% sell-off. And then the November 10 report, of course, that was a softer than expected inflation print, and that fueled a 5.5% rise in the S&P 500. And really helped extend stocks' latest rally. So definitely a second kind of helping of benign data would bolster the case for peak in inflation and really buoy equities further. Okay, next up, we'll look at the ECB meeting. We've just got the Eurodollar chart there. Just before we go to that, we'll just run through what is expected. Thursday's policy decision by the ECB. It will offer the full spectrum, if you like, of updated communications, so staff projections and the like, as well as obviously the press conference by President Christine Lagarde 30 minutes after the rate decision. 50 basis points hike is pretty much widely anticipated by consensus and also market leaning. Market has priced in around 55 basis points, so a touch above 0.5%. This would be downshifting the pace compared to the prior 2 back-to-back 75 basis point hikes. Even a typically hawkish Bundesbank president, so President Nagel, has said that a half point hike constituted just as much of a strong step as a 75 basis point hike. But the final decision could potentially hinge on how quickly the bank sees inflation returning to its 2% target in the new forecast it will publish. Expectations for those are for upward revisions to inflation for the next 2 years due to rising wages and the delayed impact of high energy costs hitting consumers. But then forecasts probably will see inflation pointing to a return to target by 2025. As always, though, of course, some of the other hawks may want to see a bigger 75 basis point hike. And some ECB watchers are thinking there is a decent, well, not a decent chance, but more of a chance than, say, that 50 basis points of market pricing that warrants potentially. Then further out, markets kind of largely priced for most of another 50 basis point hike at its next meeting in February 2nd, that is. And then a total of 75 basis points of hiking in the whole of next year, terminal rate around 2.75% to 3%. But guidance then near term, of course, in the meeting provided by President Lagarde in her press conference may be impactful. Likelihood is of a 50 basis point hike and then sort of hawkish communication, if you like, guidance with more rate hikes increasingly likely, and that would probably appease the hawks if that guidance, as we say, is on the hawkish side. Focus will also possibly turn to plans to unwind the asset purchase program. That means it's beginning, the ECB would then begin its exit from the bond market by shrinking its €5 trillion bond portfolio and then entering into QT, so quantitative tightening. In fact, Lagarde actually reaffirmed at the end of last month that key principles guiding such intentions would be presented at this meeting, but it kind of sounds potentially short of offering major details, really, which could be deferred potentially until the new year. So something to look out for if the markets, which are hoping for some detail on QT, don't get much of it really, or much color from President Lagarde. That would be a disappointment and potentially see the euro sell off. Technically then, if we look at a weekly chart, actually, you can see a doji candle on the weekly last week. That's kind of denoting some indecision, which is kind of understandable before, obviously, this ECB meeting. But if we don't just pop back to the daily, you can see technical resilience has been quite impressive, really. We shrugged off that sort of technical candle, that negative candle last week, actually last Monday, which sort of rejected that high at 105.94. And then we closed nearer the low, so sort of technical rejection, but we kind of shrugged that off, really. So dips really are finding buyers, it looks like, at the moment. We're oscillating around the 50% mark of this year's drop at 105.14. We're just above that now, and potentially if we can push up towards 106, break that 105.94 high from last week, then we are looking at more upside in euro-dollar. The next target then would be the 61.8% fib level of the this year's decline at 107.46 potentially, and then we're sort of forging a new sort of range above sort of 106 to 107 potentially, if we do break last week's high. That is euro-dollar. So then finally, just looking at the Bank of England decision, that is also on Thursday, along with the SNB decision, and I think the Norges decision as well, the Central Bank of Norway, that is. But for the Bank of England, That is followed by a press conference. Consensus unanimously expects a slower pace of hiking to arrive at this meeting, with a 50 basis point increase that would lift the bank rate to 3%. Markets are priced for such an outcome. Just checking out data and the recent comments by MPC members, they're kind of leaning towards downshifting, but not unanimously so. You kind of got the hawkish end of the spectrum, several members like Catherine Mann emphasizing the importance of managing inflation expectations, Deputy Governor Ramsden as well, sort of emphasizing the need to be a little bit more aggressive in the near term. And manage inflation expectations, or the importance of managing inflation expectations as well. Then also we've had Haskell stating it's important to stand firm against the risk of persistent inflationary pressures. That said, we also have a sort of dovish end as well, where they focused on recession worries, really. MPC member Dhingra, of course, and MPC member Tenrea as well, emphasized that policy is already in restrictive territory, according to them, or her, and ahead of the meeting in November. That's what she said, actually, before they hiked 75 basis points. So potentially we could get 3, even 4-way split in voting. Possibility Dhingra goes for unchanged, whereas we get a 25, a 50, or even a 75 basis point hike voted for. So possibly a 4-way split, more likely 3-way split, probably 25, 50, 75, probably most likely. So that's sort of the current views of the MPC members. Of course, the Bank of England is battling the fastest pace of inflation in 41 years. That, of course, is when it's raised, as I've just said, the rate by 75 basis points in November, but that was really seen as a one-off jumbo-size move. And also, given the lags in monetary policy transmission, most of the impact of the hikes already delivered is still yet to come, really, with the magnitude subject to major uncertainty. Key for us will be any changes, again, to forward guidance. That currently reads as the majority of the committee judges that further increases in bank rate may be required for a sustainable return of inflation to target, albeit to a peak lower than priced into financial markets. So beyond this week's meeting, analysts actually surveyed by Reuters expect the Bank of England will carry out a further 50 basis point rate hike in the first quarter of next year, followed by a 25 basis point hike in Q2. That would take the terminal rate to the end rate to 4.25%, whereas markets are pricing in slightly more hawkish view now. Not as hawkish as it was, of course, around the end of September in the mini budget, but still markets see a terminal rate of around 4.5%. Bank of England to look forward to Thursday. Before that, we do get UK CPI, on Wednesday. That could have an influence on the Bank of England's decision, MPC. Just briefly running through that, last month's reading was modestly firmer than expected at 11.1% year on year, an increase which was largely due to the introduction of the energy price guarantee, which caps household energy bills. November's headline is expected to ease to 10.9% year on year, while the core is seen steady at 6.5%. And that kind of tallies with the read across the months. S&P PMIs, which suggested that there were signs that inflation had peaked, though certainly remains at historically high levels. Further out, inflation is likely to remain elevated for some time, potentially, though the latest Citi YouGov survey actually welcome read for the Bank of England, as its 12-month consumer inflation expectations have eased. Okay, just looking at cable then, sterling versus the dollar. Short-term patterns similar to the euro in some ways, relatively positive, although we're sort of been consolidating recently. This uptrend in cable in sterling versus dollar is quite well established now. We're up over 14%, I think, from that spike, historic low back in September. And really, you've got quite solid trend momentum signals, sort of near term and on some of the sort of further out daily, even the weekly settings are turning mildly bullish as well. As I said, sort of dips have been bought, so decent support on any minor sell-offs. And we've got sort of up to this 121 zone and above now. The 200-day moving average looks like it will offer some support there at 121.14. And then again, if we break last Monday's high, 123.44, we're just touching up to 123. If we break that, then potentially we get up to the next fib level, the 61.8 fib level of the 2022 drop. This year's drop is at we have it at 124.52, so that is an upside target if we break last week's high at 123.44 potentially. So really interesting and quite a positive looking chart on the Bank of England, but of course much to get excited about and will influence sterling for sure. We do actually have UK jobs tomorrow. Then, as I said, UK CPI before the Bank of England decision on Thursday. Okay, it's probably time to wrap it up there. We hope you've enjoyed this webinar just around the fundamentals and some of the technicals of these huge events upcoming on the calendar. Expect some volatility. We certainly do. So just check your position sizes for sure, and any risk management tools you use, stops, limit orders and the like. Definitely prudent to be using those in this environment currently. Good luck out there, and we hope to speak to you next time.